This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. If you're new here, on the weekend we like to come back and re-examine the base case hypothesis of the channel, check to see if it's still going roughly speaking according to plan, and then of course we use that base case hypothesis to ensure I can continue to have confidence in my positioning and in my posturing. At the end, as always, I will show you my positions and where I am looking to continue to add more positions going forward. So as ever, we're going to run through this thing from the top. The base case for the stock market was pretty simple. At the lows, I thought we were way too bearish. We'd have a blow off top to all-time highs, and then we would have a big global bear market recession. And this bear market and recession would have a deflationary component to it for the third time in the US's history. It's also an idea that once we have seen the high for this current bull market, it will likely remain the high as we experience one of these lost decades and possibly even have a stagflationary component, just as we've observed when we look left here, 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 and here as the oscillator down the bottom resets itself. Fast forward to today, and you can see that we have an argument to be made, that we have completed a blow off top to 3 angles, and whilst I can't yet call tops, it wouldn't take much to see me do so. All we would really need to do is trade sideways into here and then lose this second angle, and that would be me being taken out of the market by my system. That would be me calling this the top. Of course, the inverse is true as well, right? If we can somehow push up from here, or if instead we can move our way to the second angle and then hold it as support, then I have no true top signal. I can't possibly call tops, and I would continue to have to remain long biased, expecting that this right here that I've got as the third angle was actually a temporary third angle, and thus we would be looking to set another third and final blow off top angle, likely even steeper based on the current market structure. And as always, it would be, again, rinse and repeat. We'd be looking to capture the trend, sell the third angle violation, and call tops once we got a second angle violation. So for now, I consider all of this in here to be no man's land. And if we start to push off, like I said, we'll set a third and final angle, and we'll use the same technique that we used to capture this and this by just readjusting these angles here and here and here, and we'll do the whole thing from the right-hand side. So I would say so far, so good for the stock market. For Bitcoin, this remains the one component that didn't quite play ball for me. I was expecting this cycle to left translate. I did correctly call the all-time high before the halving, but we've of course spent way longer consolidating in here than I was originally anticipating. So like any analyst should do, I pivoted as new data presented itself, and we moved towards expecting the top to come later in the cycle. So originally I was calling for this. Needless to say, we simply didn't break out of this downward sloping resistance line until much later in life, and thus I was forced to accept that something more akin to this is going on. We did manage to catch this weekly cycle low though and show that on the channel. And so now the big question remains, is the Q1 top on the table, right? Have we already seen the top? Is this working on some kind of distribution type pattern? Or does this bull market have legs for Bitcoin? Are we going to continue to see the weekly cycle lows yield, roughly speaking, 100% upside moves as they are found? Now, it's also of note here that we just so happen to be a couple of weeks at the most away from this current daily cycle low, telling me that if this thing holds, it's only reasonable to expect, at least based on the prior weekly cycles, a doubling in price, roughly speaking, from wherever that low forms. I've also said multiple times of late that once this low is in, I will draw a line underneath it and use that for me as bull market invalidation. For now, though, in the short term, I'm largely speaking happy with the performance. We've managed to capture most of the move in front of everyone, and now we're simply waiting for a weekly cycle low to form where we will get back in from the trading position. We're still holding the spot allocation from the lows, and we are looking to dump some of that and take some profit if we can get up here out of this upcoming weekly cycle low. So far, managing to stay on the right side of the trade for both the stock market and for Bitcoin. As I said right at the start of the video, part of this hypothesis is that if we're going to get this breakdown, the global bear market and recession, we will indeed have a deflationary component to this. And largely speaking, this is because anything you do to the M2 rate of change tends to show up in the inflation data, albeit with a lag. We've got an updated chart here thanks to E, and you can see anything you do to the M2 rate of change, again, shows up in the CPI, albeit with a lag. So we are currently still hypothesizing we are yet to see this part of the M2 rate of change show up in the CPI data. This point is a very contentious point in markets. A lot of market participants believe that this is much more likely and that we're going to see the resumption of inflation. But when we look at the trueflation data, okay, in the last couple of weeks, just over 2 weeks, we saw the trueflation drop off by a full percentage point almost. And so I continue to make the case that all this was up here, this rally, was nothing more than a counter-trend wobble in the primary downtrend. And I believe that what we're seeing at the hard right edge now is the resumption of disinflation. Now, we could use a simple trend line here to let us start to know where things could be going wrong. Okay, a simple trendline break in the CPI print, if we can get above here, okay, might tell us to look for one higher up. But so long as, okay, we continue to set lower highs and lower lows, then this thing is of course in a downtrend still. And especially if we can get some kind of rejection here and continue down, then of course the trend will be down and there'll be no possible way to argue that. So by the time we come back and do next week's deep dive, we should have a bit more data, of course, and we'll be able to see whether or not this downtrend is for real. The next component, of course, is if we're going to have a global bear market and recession, we would of course expect to see labor market deterioration. The labor market has been very, very challenging to navigate, simply because they continuously revise the data over and over again. There's lots of conflicting data. Over the last couple of weeks, we saw that we had around 4% unemployment, coming in slightly below the estimated in the prior readout, which had investors jumping up and down and screaming everything is A-OK. We also had the SAM recession rule coming off slightly. However, I still make the case that this thing is still making higher highs and higher lows at the hard right edge. And until we buck a trend, then to me, it looks suspiciously like a lead-in phase before acceleration, a lead-in phase before acceleration, as we see in all prior instances leading into a recession. So I don't think we can breathe a sigh of relief just yet. I think, first of all, we need to make a lower low here, but undeniably, for now at least, over the last few prints, this thing is turning down and is below the 0.5 threshold required to indicate a recession. But this jobs data continues to be challenging to navigate. Look at continued claims, okay? Not really agreeing with the 4% unemployment rate. It's the same story when we look at temporary health services, okay? Again, showing a very, very recessionary look, just like we saw in the C19 era, just like we saw in the GFC, just like we saw in the dot-com bubble. So this, of course, contradicts what we're seeing in the unemployment rate. The story remains the same for the hiring rate when we look at the NBER shaded recession areas in grey. Okay, again, at the hard right edge, looking again like a recessionary tendency here. Not really agreeing with the 4.0% historically low unemployment level that you're hearing investors parrot. And as I was showing last week, we continue to see things like non-farm payrolls experience massive revisions. This is the second biggest negative payroll revision on record. The jobs numbers were also revised down by around 600k between January and December of last year. And we saw average weekly hours of all employees again fall off a cliff and start to show recessionary looks, just like in the C19 era and just like in the GFC. And as of late this week, we also saw that the job market has effectively lost 163,000 private sector jobs in Q2 of 2024. This is a huge contrast to the monthly non-farm payrolls, 411,000 additions. So in other words, non-farm payrolls have been overstated by just under 600k jobs in Q2 of 2024. This is continuing to be an incredibly challenging environment to navigate. At face value, a lot of this data looks just fine. But as soon as we start to scratch a little bit below the surface, everything again continues to look worse and worse. It's a very, very challenging data set to navigate. The data that is released one month is revised quietly the next month. This, to me, makes me feel a little bit uneasy and has been for quite a while now, actually. Quite a few months I've been feeling a little bit uneasy, especially since there's an awful lot of parroting of narrative going on. And one of those narratives is that 4.1% or 4.0% is historically low. But we only have to look back at prior recessions to see that 5 out of 12 of them started at 4.1% unemployment rate or less. And least we forget the one from the 50s, which started at just 2.6%. So then the question becomes, is 4.1% or 4.0% really historically low? Is it really nothing to worry about? Is it the only data source we should be consulting? And should we be completely ignoring all of these other data sets? Should we also be ignoring the major revisions we continue to see? I continue to try my best to stay on the right side of the trade based solely on the charts whilst paying attention to this macro data. But I do think at some point we are going to get a second angle violation and a breakdown. And when we do, I think we're going to be able to look back at everything I've presented today and more and say, do you know what? That was very, very long overdue. We also continue to monitor the high yield credit spreads, and so far we continue to see even more historical compression. Now, that's absolutely fine until we get a breakout. No reason to sound the alarm just yet, but a breakout, should it occur, is to be respected since these are synonymous with financially stressed conditions. Again, fitting in with this theme of looking under the hood and seeing that things don't look quite as they should, we can see that the Chicago PMI, whilst it ticked up at the last readout, is still showing a very recessionary look, significantly below the 50 level, which is indicative of economic contraction. It's a read above 50 that we would expect to be indicative of economic expansion. And again, we have been down here for a very, very long time. You'll notice normally when we trade below 50, okay, things are not so good like the C19 era. Again, we trade below 50 for any significant length of time back in 2008, 2009, and of course things are not good. And it's the same deal here. When we're significantly below 50 for a significant amount of time, it's also the dot-com bubble blowing up. So why is it at the moment that everything seems fine? Again, it's a very, very challenging data set to navigate. We can also point at things like the home builder spec inventory, which continues to climb. Right, it continues to be sat around the level that we last saw at the GFC, again, drawing more and more parallels in some of the data sets. And of course, the delinquency rate on commercial mortgage-backed securities is also right up in that neighborhood where we saw financial unwinds and crises in the past. The majority of Americans feel like they're in a recession, and you can see that the expectations over unemployment for the upcoming 12 months are the most pessimistic since the C19 era, and also starting to head down towards those GFC levels. And in the past, such pessimism has happened only in recessions and always implied higher joblessness rates over the next few months, telling us to keep an open mind at least about seeing the unemployment move to the upside with labour market deterioration to follow. However, the one saving grace, again, the one thing keeping us in the market appears to be the charts. I've long been pointing at the yield curves and telling us that they are a barometer for when to respect breakdowns in the stock market, when to look for major reversals and trend changes to come in. And again, it's always in the details. The inversion in the yield curve, everyone jumps up and down and screams recession and they're wrong. The reversion in the yield curve, again, people scream for a recession and they are again wrong. It's the acceleration to the upside as defined by weekly higher high and higher low closes that is synonymous with tops coming in. And we see this every time. Acceleration is what causes tops to come in for the stock market and causes breakdowns to need to be respected once we see the acceleration. But as we come and check in on these yield curves again, as we do every weekend, we can see that so far, okay, we have got higher highs and higher lows, but this thing for the past 4 or 5 weeks is starting to move to the downside. We initially were following this yellow squiggle, and since then we're diverging away. So all the while that we continue to move to the downside or sideways, we can happily say, okay, no need to be super alarmed at this current moment in time. But if over the next coming weeks we continue to push to the upside, setting again another higher high, okay, here, and again another higher low, then that tells me at least that any breakdown from any kind of second angle in the stock market or in Bitcoin should absolutely be respected as we are morphing into a severely risk-off look. So far we don't have to sound the alarm just yet, but we do need to keep an eye on this and continue to follow it, because as I show often, this acceleration from here to here happened in just 3 weekly candles, giving you very little time to react to the C19 plunge. If we swap out the 2-year yield for the 3-month yield, we can also see this is undeniably got the potential to morph into a higher high and higher low type accelerative look. But as of right now, we continue to move down. So any kind of sideways chop in here, okay, any kind of inversion again to the downside, and we can say, okay, this market probably has legs. We can continue to have confidence in our bullish posturing and in our long posturing. But again, we must keep an eye on this because we get very little time to react here. This is just 3 weekly candles to let you know it's time to be respecting breakdowns as they're occurring in the stock market. So any look other than this, and I think we can say happy days, long and strong, continue to push. But again, we'll continue to check in on this and keep a close eye on it because we really don't want to see this thing move towards a accelerative look. So over in the stock market, for now at least, it's hanging out in no man's land, as I said. We have got a daily cycle low at the end of the month, and we've also probably left behind a half cycle low now, so we'll see if we can get a push. It is interesting to me that the Nasdaq seems to be pushing up, and in the level 3 members section, we actually got long the Nasdaq on Thursday as we were experiencing this breakout out of the half cycle low. The VIX continues to set new lows, and we continue to target this area down here between the 2 green lines for some hedges, and we are slowly but surely lining up a re-entry into the Russell 2K index. We did really well catching this move off the lows. We took some profit, and now we're getting ready to once more line up another trade. Gold continues to keep bread on the table for the family. It looks like we're starting potentially a decline over the next few sessions into that daily cycle low, and then you can see we've got the long position lined up here to take advantage of that. We have been capturing this move via the silver markets and a whole heap of mining stocks, again in the level 3 members section. And Bitcoin continues to waddle its way down towards the daily and the weekly cycle low, where again we are looking to catch this move. We are looking to get some trades on here, and we are looking to extract additional beta from the market using the crypto related equities in the level 3 members section. So we've been lining this up, waiting very, very patiently for this. Again, it also fits with this idea that you can see posted all the way back
mid-January. We are getting ever closer to this weekly cycle low time frame, and as we get there, like I said a million times, it will be time to finally get hold of some trades and look for a doubling from the lows. So that's it from me. If you're a level 3 member, look out for the members only video I'm about to post for you guys. We've got a whole heap of trades to get behind in the coming week or two, particularly in the crypto markets. For everyone else, I hope you have a fantastic weekend. I hope you're doing well in life, and until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a bad